Welcome to the Opening Bell Report.
If you are joining us today, you are honestly in for a seriously fascinating exploration.
Yeah, absolutely.
We've got our hands on a really highly detailed financial analysis report, and it maps out this rather jaw-dropping market anomaly.
It really is.
And we're not just looking at, your standard everyday market fluctuations here. We are zeroing in on an absolute spectacle today.
A spectacle is the right word for it, yeah.
The central focus of our deep dive revolves around one specific, just staggering number, and that is a $201 million net inflow.
Right.
And to be clear, that wasn't over the course of a year. That wasn't some quarterly portfolio reallocation. That $201 million poured into the United States oil fund, which is universally known by its ticker symbol USO, in just one single week.
It's an extraordinary influx of capital. I mean, when you pair that figure with the price action that actually came with it, the picture becomes incredibly dramatic.
Right, because the price didn't just tick up.
No, not at all. We're looking at an asset that experienced a 13% single-day gain. Yeah, and for anyone tracking commodities, you know that a 13% jump in a single trading session on a major oil fund it's practically seismic.
Definitely.
It gapped up violently right at the market open and then relentlessly held its ground near a 52-week high. So this isn't just a chart ticking upward on some mild economic data. This is a very loud, very aggressive market signal flashing bright red.
A 13% gain in one day definitely explains why it's catching everyone's attention. But the mission of our deep dive today isn't just to, stare at a rising chart and marvel at the momentum.
Exactly. We want to look under the hood.
Right. We want to decode this for you. We're going to break down exactly why institutional smart money is aggressively treating USO as the ultimate, undeniable trading vehicle right now. And we want to get into what this massive inflow reveals about global market panic.
That is the crucial context we need to establish for you. The goal is to reverse engineer that institutional signal. Because when you see capital moving at this velocity and this scale, it is never random.
It's calculated.
Highly calculated. It's deeply strategic. And it speaks volumes about how the absolute largest players in the financial ecosystem are actively pricing in the immediate future.
Okay, let's unpack this because we need to start with who is actually throwing this kind of weight around.
Right.
Right out of the gate, the analysis report makes a very firm distinction. A $201 million footprint over 5 trading days. That is not a bunch of retail traders sitting on their couches hitting buy on a mobile app.
Not even close. When you look at the block sizes and the execution patterns here, this is a massive, concentrated footprint of institutional smart money.
The heavyweights.
Exactly. We are talking about major hedge funds, global asset managers, institutional trading desks. They aren't casually adjusting their long-term portfolios here. They are aggressively, almost desperately, positioning themselves for a very specific, acute outcome.
They're bracing for impact.
Yes. They are preparing for a shock to the system.
And the trigger for that shock, looking at the macroeconomic landscape laid out in the report, is a severe disruption to the global oil supply.
Wall Street is currently pricing in acute geopolitical tensions that are directly threatening both physical output and critical shipping lanes.
Specifically in the Middle East.
Yes, particularly in the Middle East. When the market perceives a legitimate, imminent threat to the physical delivery of a crucial commodity, especially in a historically volatile choke point, the reaction is incredibly swift.
Because you can't just invent more oil overnight.
Right. And this specific geopolitical tension has caused the risk premium on West Texas Intermediate, or WTI crude, to absolutely skyrocket.
Wait, let me stop you there. Because if you're an asset manager trying to protect a massive portfolio from inflation or a supply chain breakdown, why wouldn't you just buy energy equities?
That's a common question.
Like, why not just dump that capital into Exxon or Chevron? Why do you need to touch physical oil futures to build a shield?
That's a really great distinction to make. If you buy Exxon, you are taking on equity execution risk.
Okay, meaning what exactly?
Meaning you have to worry about the company's management, their dividend policy, their specific quarterly earnings, and broader stock market correlations.
Ah, right.
If the whole stock market crashes because of a broader geopolitical shock, Exxon might still go down with the ship, even if oil prices are rising. These institutions don't want equity risk right now. They want pure, unadulterated commodity exposure.
Okay, I see. They need a direct line to the commodity itself without the corporate baggage.
Right, and if we connect this to the bigger picture, we can understand the mechanics of the panic bid.
The panic bid?
Yes. This $201 million inflow isn't necessarily about trying to profit from the rising price of oil. For a lot of these massive institutions, it's about sheer survival.
Protection.
Yes, they manage vast, complex portfolios that are highly vulnerable to sudden macroeconomic shifts.
Yeah.
An oil shock doesn't just make gas more expensive at the pump, it cascades.
It hits everything.
It destroys manufacturing margins, it spikes global shipping costs, and it triggers rampant inflation. which then forces central banks to react.
Which hurts their other investments.
Exactly. They desperately need immediate exposure to crude oil to hedge their broader portfolios against those cascading effects.
Yeah.
It's essentially buying financial fire insurance while you can literally smell the smoke.
Which brings up a really interesting mechanical question. If these massive desks want pure, immediate oil exposure to hedge against these geopolitical fires, why pour hundreds of millions of dollars specifically into USO?
Well,
Because there are other commodity vehicles out there. Why is USO the chosen escape hatch for this panic bid?
it comes down to the underlying architecture of the fund itself.
Okay.
USO specifically tracks short-term, front-month WTI crude futures.
Okay, front month. So they aren't looking at oil deliveries for next year. They're looking at the absolute most immediate contracts available.
Exactly. In the futures market, you have all curve of contracts. You can buy oil for delivery next month, in 6 months, or a year out. Front month is the contract with the closest expiration date. Because USO focuses almost exclusively on these short-term contracts, the fund's price reacts violently and instantaneously to immediate supply threats.
Because that's where the fear is.
Yes. If there is a sudden threat to a major shipping lane this afternoon, it's the front-month contract that spikes the hardest. So, USO perfectly captures the pure, concentrated upside momentum of the market's panic bid.
It's the purest reflection of immediate fear. But looking at the trading data in the analysis report, it's clearly not just about what the fund holds. It's about how easily these big players can move in and out of it.
A volume.
The sheer scale of the volume here is staggering. We're talking about USO trading an average daily volume of roughly 18.5 million shares.
18.5 million shares every single day.
That's huge.
To put that in perspective for you, its closest commodity tracking competitors are trading only a fraction of that amount. USO completely dwarfs the rest of the energy ETF space in terms of sheer turnover.
And for a hedge fund, that volume is everything.
It's the only thing that matters.
Because if you try to dump $100 million into a small, illiquid fund, you're going to run into massive slippage.
Oh, absolutely.
You'll drive the price up so fast that you ruin your own entry. And then when the crisis is over and you try to sell, the order book will be completely empty. You just crash the price trying to get out.
That is the concept of market impact, and it's exactly why volume matters so much to institutional capital. That massive daily volume creates a vital liquidity premium.
Liquidity premium.
Yes, when a trading desk needs to deploy 9 figures overnight to hedge against an escalating conflict, illiquidity is a deal breaker. They need incredibly deep order books.
They need to know they can get out.
Right. USO's liquidity allows these massive institutions to exercise tactical agility. They can enter a $200 million position instantly. And just as importantly, they can liquidate that position instantly.
With minimal damage.
Yes, they can do all of this with incredibly tight spreads. That unmatched depth makes USO the undisputed king for fast, tactical geopolitical trading.
Okay, here's where it gets really interesting. Because the underlying data reveals a structural secret driving this massive cash grab.
The hidden engine.
Yes, it's not just the geopolitical fear, and it's not just the liquidity premium we just talked about. There is a hidden engine at work here, buried deep in the mechanics of the futures curve itself.
To fully grasp why Wall Street is so perfectly comfortable parking hundreds of millions of dollars into USO right now, we have to look at the shape of the oil futures curve. Specifically, the shift from contango to backwardation.
Let's get into that because typically USO actually faces a massive structural headwind. Usually the oil market is in a state of contango.
Right.
And just to define that simply for you listening, contango means future contracts cost more than current contracts because you're paying the cost of carry, the storage, the insurance, all the physical realities of actually holding barrels of oil.
And that cost to carry is historically a huge drag on a fund like USO. Because remember, USO holds those front-month contracts.
The immediate ones.
Yes. But as those contracts approach expiration, the fund doesn't actually want to take physical delivery of millions of barrels of crude in Cushing, Oklahoma.
Right. They are a financial fund, not an oil refinery.
Exactly. So they have to roll their position. They systematically sell their expiring contracts and buy the next month's contracts to maintain their continuous exposure to the price of oil.
Okay.
In a normal contango market, they are forced to sell cheaper expiring contracts and buy more expensive future contracts.
Right. So they're essentially paying a premium every single month just to roll the position.
But the current geopolitical panic hasn't just spiked the price of oil. It has fundamentally altered the physical market dynamics.
It's flipped it.
It has violently flipped the futures curve out of contango and into a state of steep backwardation.
Steep backwardation. So the curve has completely inverted because of this acute supply shock.
Yes. And if we look at historical context, the contrast is wild. Think back to April 2020 during the lockdowns.
Oh, when oil went negative.
Exactly. Storage was overflowing. No one wanted physical oil. And the front month contract famously crashed into negative pricing. That was super contango.
Right.
Today, we have the exact opposite extreme. The market is terrified of immediate supply disruptions. Oil is desperately needed right now to keep logistics and manufacturing afloat.
The panic bid.
Yes. That immediate demand is so overwhelming that the front month contracts are suddenly trading at a massive premium compared to contracts 6 months down the line. The market is essentially saying, we don't care what oil costs next spring. We will pay whatever it takes to secure physical delivery today.
Okay, so how does that affect USO's structural decay? If the front month contract is suddenly the most expensive on the board, what happens when USO has to roll its positions?
What's fascinating here is how backwardation turns that historical weakness into a massive supercharged tailwind. When USO rolls its contracts in a backwardated market, it sells its expiring front month contracts at a highly inflated premium driven by that immediate panic. And then it turns around and buys the next month's contracts, which are actually cheaper.
Wow. So by systematically selling high and buying low during the roll period, the fund is effectively capturing a positive roll yield.
Exactly. They are capturing a positive roll yield. Instead of bleeding value to the cost of carry, they are actually gaining an invisible boost simply from the mechanics of the futures curve.
That is incredible.
Institutional desks love steep backwardation because it temporarily turns USO from a decaying asset into a compounding one.
So it's a double win for them.
Oh, absolutely.
Not only are these funds riding the underlying momentum of rising crude prices due to Middle East tensions, but the very structure of the market is actively paying them a premium just to hold the position.
Right. When you look at it from a pure trading mechanics perspective, it's no wonder $201 million rushed in.
You have a geopolitical catalyst driving the spot price up, unmatched market depth allowing them to move massive blocks of capital safely, and a backwardated futures curve providing a positive roll yield to supercharge the returns.
It is the perfect storm for a quantitative or macro trading desk. It is a highly engineered, deeply strategic play that capitalizes on a very specific set of temporary market conditions.
So what does this all mean? We've mapped out the massive inflows, the geopolitical fear driving the panic bid, the necessity of liquidity, and this secret engine of the positive roll yield.
Yes.
But we need to look at the reality of how this plays out because the data we are looking at in the analysis report doesn't just explain why this is happening. It strongly implies a very stark warning about what comes next.
It does. It provides a crucial reality check for anyone observing this price action.
A reality check.
Yes. While the current market setup for USO is undeniably bullish, it is absolutely vital to remember the underlying nature of the instrument. USO is a tactical trading vehicle. It is designed purely to capture short-term front-month momentum.
And that is such a critical distinction for you to keep in mind. USO is not a buy and hold asset.
Definitely not.
This isn't something you drop into a retirement account and ignore for a decade, assuming oil prices will just generally go up over time.
And the reason you can't hold it long-term ties directly back to the mechanics we just walked through. The massive advantages USO is currently enjoying, that positive roll yield, and the front-month premium, are temporary.
They depend on the panic.
They're entirely dependent on crisis conditions. The ultimate risk hanging over this entire trade is the threat of de-escalation. The moment those geopolitical tensions in the Middle East begin to cool off or a diplomatic resolution seems possible, that acute panic bid will evaporate.
And when that panic bid evaporates, the desperation for immediate, prompt physical delivery drops.
Right, and the moment that immediate demand drops, the futures curve flattens out and normalizes. It will flip right back from backwardation into contango.
Oh, and the hidden engine breaks.
Exactly. The positive roll yield will vanish instantly, and the fund will go right back to facing that structural decay, paying the cost of carry every time it rolls its contracts.
And let's be real about what that smart money is going to do when that shift happens. They aren't going to stick around out of loyalty to the fund while it bleeds value.
No. The data doesn't pull any punches here.
The second those tensions cool and the curve flattens, that $201 million in hot money is going to hit the exit.
Without a doubt.
And because of that deep liquidity we talked about earlier, they can vanish in a heartbeat. They will liquidate those 9-figure positions, take their profits, and leave the underlying price to collapse back to its normal state.
It is quite literally a tactical escape hatch for institutional capital. They utilize it when the macro conditions are perfectly aligned, and they abandon it the exact second those conditions normalize. That is the harsh reality of trading a derivative instrument built on front-month futures during a geopolitical crisis.
Okay, let's briefly recap the mechanics of this incredible market anomaly we've just explored. We started by looking at a staggering $201 million institutional footprint, a massive concentrated panic bid playing out over just 5 days.
Right.
We broke down how this was triggered by severe supply fears and acute geopolitical tensions threatening output in the Middle East, and how that forced asset managers to desperately hedge their broader portfolios against cascading inflation and supply shocks.
And we also dug into why they required USOs specifically. They needed its pure exposure to short-term front-month futures to capture immediate upside. And they absolutely relied on its massive daily volume of 18.5 million shares.
The liquidity.
Yes. That unparalleled liquidity allowed them to move hundreds of millions of dollars with tight spreads and minimal market impact.
And finally, we uncovered the secret engine driving the trade. We explored how the acute panic flipped the futures curve from a value-bleeding contango into a state of steep backwardation.
The positive roll yield.
Exactly, which temporarily turned USO's biggest historical flaw into a supercharged compounding advantage. All of these factors converged to briefly turn this fund into Wall Street's favorite highly engineered trading vehicle.
But we also outlined the reality check. This is not a long-term investment. It's a highly reactive temporary play.
Right.
Which raises an important question. A final thought for you to take away and mull over after we wrap up here.
Let's hear it.
If institutional smart money is utilizing massive commodity funds like USO purely as rapid fire, 9-figure tactical escape hatches at the first hint of geopolitical friction.
Yeah.
What happens to the everyday retail investors who see a 13% gain on a chart, mistake these highly engineered short-term momentum trades for a fundamental long-term market trend, and buy in just as the smart money is quietly preparing to exit?
That is a phenomenal question, and it's exactly the kind of critical behind-the-scenes thinking we want to leave you with today. In the financial markets, things are rarely as simple as a line.
Don't forget to like, share, and subscribe for more.